When people hear the word bonds, they often imagine something boring, slow, or overly technical. But bonds are actually one of the simplest financial concepts to understand. In fact, once you grasp the basic idea, you realize that bonds are everywhere. Governments use them, companies use them, and the entire financial system relies on them. At their core, a bond is just a loan. But instead of a bank lending money to someone, you lend money to a government or a company, and in return, they promise two things. First, they will pay you regular interest. Second, they will pay you back the full amount, called the principal, when the bond matures. The best way to understand a bond is through a simple real-life example. Imagine your friend wants to start a small business, but they need $1,000. They tell you, if you lend me the money, I'll pay you 5% interest every year and return the full $1,000 to you in 5 years. You give them the money. They give you a written promise. That written promise is a bond. In financial markets, the same thing happens, but on a much larger scale. Governments issue government bonds. Companies issue corporate bonds. Cities issue municipal bonds. Bonds have three key components. The first, the face value, the amount you lend. The second, the coupon, the interest rate that they pay you. The third, the maturity date, when they pay you back. Now, here's something important. Bonds are usually considered safer than stocks. Why? Because stocks represent ownership, which can rise or fall dramatically. Bonds represent debt, and debt must be repaid. Bondholders get priority if something goes wrong. Government bonds, essentially US Treasury bonds, are considered some of the safest investments on earth because the US government is extremely unlikely to default. Corporate bonds carry more risk, but also offer higher interest to compensate. But bonds do something fascinating. They move opposite to interest rates. When interest rates rise, bond price fall. When interest rates fall, bond price rise. It sounds backwards at first, but the logic is simple. If new bonds are paying higher interest, nobody wants old bonds with lower interest, so those old bonds become cheaper. If new bonds are paying lower interest, all bonds with higher interest become more valuable. This relationship is critical because central banks, like the Federal Reserve, affect interest rate all the time. Every announcement from the Fed can move the bond market instantly. Bonds also play a huge role in portfolio management. Many investors combine stocks and bonds to balance risk. Stocks provide growth, but they are volatile. Bonds provide stability and predictable income. Professionals often use something called the yield curve, which shows interest rate for bonds with different maturities, from very short term to very long term. The shape of this curve tells you what investors expect for the future. When the yield curve inverts, meaning short-term yields are higher than long-term yields, it often signals economic trouble ahead. Historically, inverted yield curves have been reliable recession indicators. Now, let's talk about how traders actually use bonds. You can trade treasury bond futures, bond ETFs, bond CFDs, corporate bond funds, municipal bond funds. These instruments move when interest rates move, which makes bond trading a powerful way to speculate on economic conditions. Bonds are also essential in smart money concepts and microanalysis. When big institutions become fearful, they often move money into bonds, especially US Treasuries. This is known as the flight to safety. When confidence is high, money moves out of bonds and into riskier assets like stocks. This is why traders always watch bond yields. When yields rise quickly, markets get nervous. When yields fall, markets often relax. Bond yields aren't just numbers, they're signals of how the world is feeling. Let's bring this together with a simple story. Imagine the economy is slowing down. Investors become cautious. They start buying government bonds for safety. Bond prices go up. Yields go down. Stocks might fall because investors prefer security. A few months later, the economy recovers. Investors leave bonds and jump back into stocks. Bond prices fall. Yields rise. This constant dance between fear and confidence is the heartbeat of the financial system. So to summarize, bonds are loans you give to governments or companies. They pay interest and return your money at maturity. They are generally safer than stocks. Bond prices move opposite to interest rates. They are essential to understanding the global economy, and they help investors balance risk and stability. Once you understand bonds, you understand interest rates, economic cycles, and the deeper psychology behind market movements. Bonds aren't just slow, boring investments. They are signals, quiet but powerful. They reveal exactly what the financial world is preparing for.